Hello and welcome to BQ Prime. You're watching this special on the occasion of the RBI policy, and joining me is Harsha Upadhyaya, who is the Chief Investment Officer, Equity, and President at Kotak Mutual Fund. Harsha, thank you very much for joining us on BQ Prime. To begin with, the street was expecting status quo, and RBI delivered a status quo. But what is your take on the kind of commentary that came in from inflation and growth point of view?
Good afternoon. Clearly, as you mentioned, I think whatever the consensus expectations were there, that has been met by the RBI policy today. Clearly, on the inflation trajectory or on the growth expectations, broadly, market also expected similar points to come out from the RBI policy, and that's what has happened. As you rightly mentioned, there is no change in the repo rate as well. So overall, I think it's a status quo, but clearly, I think it also shows that we are in a much comfortable position today than where we were a couple of quarters earlier in terms of tackling inflation. And today we really have a positive real rate as against a negative real rate that we started with when the interest rate cycle started. So hopefully over a period of time we should be able to tame inflation.
On the inflation front, it's still projecting a little above 5% inflation for the entire financial year of FY24. Do you see there is a risk to it, though the RBI has said that it's a balanced risk which it's working on as of today. But do you see any risk to this inflation which RBI is pegging at?
Even in our expectations, we believe that the numbers are going to be more or less similar. Yes, the risks are balanced in that sense. We need to watch out for how monsoon progresses this time around. But as of now, the number seems to be quite in line with expectations.
Putting everything in perspective, Harsha, how do you see that auguring for the markets as a whole, especially some of the key sectors which are sensitive to rates and to monsoon?
Clearly, market is taking a comfort that probably we are going to see extended pause from RBI, and also hopefully at some point of time in the near future, you could also expect a cut in interest rates if inflation continues to moderate. So those are the expectations that are there in the market, and to that extent, I would say a market has taken the RBI policy in its stride. There has not been much of volatility today during the policy meeting. So overall, we believe that the trend for the equities will continue to remain what we have seen until now.
Also, can you give us a perspective on we just came out with the Q4 numbers, and FY23 numbers are out. So based on that, how do you see the earnings growth, and what is the kind of quality of earnings that you've seen, and your perspective on that?
Clearly, fourth quarter results were slightly ahead of expectations at the aggregate level, I would say, although there were disappointments when you look through the numbers. But the headline numbers at least were slightly ahead of expectations. Not only ahead of expectations, but they were also ahead of what we have seen for the past 3 quarters in terms of the average earnings growth per Nifty. For example, in the first 3 quarters, the average earnings growth per Nifty was about 12%. In the fourth quarter, we have seen about 16% earnings growth. So to that extent, I would say it's been slightly better than what we had seen in the past. At the same time,
do you see this growth coming homogeneously across sectors, or is it some sector specific like financials and autos which have been doing well?
Clearly, this has been driven by autos and banking and financial services sector. To an extent, this is dragged by commodities and oil and gas sectors, I would say. Nevertheless, as you look forward, there is definitely a likely benefit that will come as commodity prices have moderated and are continuing to moderate. Many of the other segments can also see a cost moderation coming through lower raw material costs or fuel costs, and that should aid profitability. And if demand continues to remain as we have witnessed until now, or if it improves from these levels, the help in profitability margins and along with stable demand to drive better earnings growth for overall market. That's something that the market is hoping for.
As part of your portfolio allocation, are you still, I mean, are underweight in the sectors which you mentioned where the earnings growth hasn't been much?
Not all of them. In many domestic businesses, for example, cement, industrials, etc., while the margins have not really gone up yet, but we do believe that over the next 2 to 3 quarters, you will see a substantial improvement in terms of the overall profitability margins. And we are also very confident about the overall growth in those sectors. So that's where we continue to have our overweight positions. But there are also many other sectors where earnings growth is missing or has been volatile, where we have underweight strong stance. But those are essentially global facing businesses, IT services and metals and commodities in general.
Do you think that IT is going to be a washout? It's going to be a washout here for the IT, as some of the analysts are penciling in?
I won't say it will be a washout here, but definitely compared to some of the domestic sectors, probably it will continue to underperform in terms of the earnings growth. So to that extent, probably on a relative basis, the sectors that I mentioned on the domestic side, let's say auto, BFSI, cement, etc., would probably give you better stock performance than the IT services sector.
What about oil and gas? Is that going to be a normal year for them? Because we're seeing murmurs within the OPEC to keep prices high, though there's no consensus among members there. But do you see oil being steady at the current levels, or do you see some spike happening towards the end of the year?
Clearly, OPEC is trying to support the prices. That becomes very evident from the kind of noise that is coming from OPEC members. Until now, that has not really had an impact on the prices, I would say. It continues to track how fundamentals are moving in the global scenario, which shows that there is weakness for all commodities, and we have seen that continuing even for crude oil, and hence the prices have been weaker than where they were 12 months earlier. So to that extent, as of now, the OPEC action has not really led to any negative surprise on the prices for the consumers. So to that extent, I would say that the trend of expectations of improved fuel costs or lower fuel costs fueling the higher profitability would continue to dominate overall market discussions.
Within your portfolio, Harsha, which is a sector that you are overweight on or bullish on, and which is a sector where you're playing neutral?
Clearly, some of the domestic segments that I mentioned, which are cyclical, which are seeing the improved demand conditions as well as expectations of better profitability. For example, auto, cement, banking and financial services, even industrials. These are some of the segments where we have been overweight. And IT metals continue to be underweight positions in our portfolio.
What about consumption sector? Because that's something which everyone also is looking very carefully. FMCG consumption, rural demand. What is your view on that? Have you seen in your interactions with managements and analysts, some pickup happening in the rural demand?
Clearly, after the fourth quarter results, the interactions that we have had with many of the companies operating in the rural environment or in the consumption space clearly indicate that there is some expectation of a revival in terms of rural demand over the next couple of quarters. But obviously, this would also depend on the monsoon progress. So at the moment, it is not very clear, but we are hopeful that we would see a better demand conditions even in the rural segment as we go forward. If that comes through, I think consumption can also become a good sector to really bet on. This sector has not performed for last several quarters. One, because the valuations were high and also demand conditions were not very conducive for higher growth. And we also had the gross margins shrinking given input prices, inflation in the input prices. Now, all of this seem to be kind of normalizing, and that should give you a better profitability growth even in the consumption sector. So I would say this would probably be a dark horse at this point of time. And if monsoon doesn't disappoint, then many of the consumption companies could see better days ahead.
Finally, Harsha, we saw the RBI commentary. In your opinion, how are you penciling in a rate reversal, or by when do you see a rate reversal cycles beginning in? Though RBI is talking about a pause at this moment, as and when the rate reversal happens, some of the sectors which are bullish on, like the financial and banking, will the dynamics will start changing in this sector. So, how do you see that panning out?
At the moment, we are not penciling in any rate cuts. Clearly, I think as RBI has also pointed out, the comfortable levels for inflation in the country, according to them, would be around 4%. So we are still much higher than that level for RBI to really think about cutting interest rates. And also, it's not been a mature interest rate cycle, as in the latest hike was a couple of months earlier, right? So our expectation is as you go towards the end of the financial year, if inflation continues to moderate from these levels as well, beyond what RBI has been expecting, then probably you could see an interest rate cut. Otherwise, it will be an extended pause.
Harsha, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you so much.